right, we are live. We have a couple of minutes before Jerome Powell speaks. I believe the summary of economic projections have just been released. Let me just take a look at this. Welcome. This is the first time we are streaming the FOMC. I'm not too sure whether or not I'll get everything put together, but welcome. So what I have on screen right now is the summary of economic projections. I think just off looking at it, it does seem like they are projecting GDP to increase for the rest of the year, which is fairly surprising. I think considering whatever is happening in the Middle East with rising oil prices, I think this kind of means that, it seems like perhaps perhaps the Federal Reserves are not as worried about what is happening. No worries. Hi, Bob. No worries. You can stay as long as you need, and then you can leave whenever. I will just be here trying to figure out how to stream the FOMC properly so that I can do that more consistently in future. We are 4 minutes and 45 seconds away from Powell speaking. All right, so when I take a look over here, it seems like they have revised up the median growth numbers slightly. I believe if I take a look at the summary of economic projections back in December, they had 2026 down at 0.3. Give me a second. Let me share my. This is the economic projections in September. If you take a look at the GDP projections for 2026, you can see that the projections here are for 2.3. Sorry, let me zoom this in. Right, so we're just looking at the median projections. Change in GDP in 2026 is 2.3, unemployment rate at 4.4%, inflation at 2.4%, and federal funds rates at 3.4%. So this is what exactly we are looking for before Powell speaks today. We're just a couple of minutes out. So let's compare this to what we are seeing in the summary of economic projections that has just been released. So if you take a look over here, this is what we are seeing today. So right now, if I put this side by side, let me take a look. In terms of 2026 GDP, okay, so we are expecting a rise in GDP, which, like I said, is surprising considering everything that is going on in the Middle East right now and with rising oil prices. We are expecting unemployment rate to actually stay the same at around 4.4%. So this is well within SoFi's terms or SoFi's projections, but they are seeing a slight tick up in inflation, right? So I believe PCE inflation we saw just now was 2.4%. Right now, they are expecting 2.7%. But even so, I do think that the Federal Reserve does feel like the war in the Middle East is not going to be as long lasting as most people expect, because despite the higher inflation, they are keeping the federal funds rate stable at 3.4%. So this means that they are seeing possibility that the war would actually drive up the prices of oil, which will drive up inflation. However, they are not in a rush to try and hike interest rates right now, and so that is good for the markets, which is why I think we are seeing a fairly muted response by the market. So if I take a look at what the markets are doing right now, I think we should be okay. If you take a look over here, S&P still down 0.7%. Let me just shift this to, if I take a look at the 5-minute candle, you can see that in the last, I guess you can say, summary of economic projections released over here, markets came down a little bit, perhaps due to the higher inflation rate, but then not by much, right? Since then, it has actually it's starting to rebound a little bit. And let's see what happens as Jerome Powell starts to speak. But if you zoom out on a daily basis, you can still see my line that I've drawn over here. I feel like as long as we're having problems getting over this 671, we are likely going down to test somewhere around the 200-day moving average. I think that is only normal, and we do have pretty strong support over here. I would expect that, should things stay status quo, which means that the war is, in uh, the war is in the current state that it is now. There's no real escalation. I think boots on the ground might bring this down past the 200-day moving average, but I think beyond that, I think beyond boots on the ground, I think we do see this come down, test the 200-day moving average, and perhaps bounce back from here. Right, Nasdaq is just down 0.5%. Again, you can take a look at the Nasdaq. It's really been range bound, stuck between the 50-day, 200-day, very tight range for quite a while now. And I think this time around it's no different. We should see a bounce off around the 590 range, which actually more or less lines up with the 200-day moving averages. All right, is power on yet? No, we are still waiting. We are still waiting. We're a couple of seconds away, probably a minute away. Once he's on, I will switch to Pao, and then we'll comment as we go along. I think the first part is pretty straightforward. He's going to read from the script, and then after that, he's going to be taking Q&As. All right, so back to the charts. Let's see. Moving down, I mean, the VIX still slightly elevated. If you're the kind that has been you're super into technicals, this isn't necessarily a good thing because the VIX is still in an uptrend. Sometimes I find it very hard to predict these things because although you can say yes, it is in an uptrend, but then there needs to be a catalyst, any kind of catalyst to drive this up even further. So again, remains to be seen. Singapore stock market, I mean, let's see how this will respond tomorrow with Bitcoin at 71,000, close to 72,000. Again, we are bouncing off. It seems like we are bouncing off the 50-day moving average, which is not a bad thing. Similarly for Ethereum, seems like this has come down. I wouldn't say it has fully tested the 50-day moving average, but close. And then if we get a bounce back up, hopefully, like I was saying in today's stream, we can get a bounce back at least to the 3,200 ranges. All right, Paul is on. Let's take a listen to what he has to say. Let me know if you guys can hear it.
Briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net, we didn't make progress. And if you look at total core inflation, it's about 3%. And some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind. And the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment. Just curious, kind of what's the genesis behind the need? What's the need?
I think this is a good question.
Yeah, so, there are 19 people, and so 19 reasons, 19 individual submissions, but and if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation, not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year, progress on tariffs, going through once and then the tariff inflation coming down. We should be seeing that. And,
So
the rate forecast
tariffs
is conditional
to be
on the performance of the economy.
at least
if we don't see that progress,
by the end of
then
this,
you won't
by
see
the
rate
middle of
cut.
this year. That's interesting.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil. But it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
The consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So, and the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass through. So people write down, this is one of those SEPs where a number of people mentioned, if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just, you got to write something down. And this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid. And inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah.
About
so there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be actually. And, it's one of those things where it's a repeated set of things. And you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that. And we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick Timmeros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay, so I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0, and it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks. And we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If
I don't
wage
think
growth
the
has come
market
down,
like
if
that
the labor market
comments
has
because
loosened,
I started to see the
why has
markets come
non-housing
down
services
after,
inflation
after he said
maybe
that they
been
are staying
slower to
mildly
follow?
restrictive.
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level. We do expect that they will come down, but it's
At this
it's
point, we
a
might
bunch of
not make it to the
idiosyncratic
end of
things, but at
the
the same
press
time,
conference.
that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can, we're at 3.0% core inflation, 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Are you guys not
Thank you
going to
very
miss
much, Claire
Powell when
Jones
he's
from
not
the
around?
Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent would you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned. I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take? And was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it. And I mean, everybody understands the arithmetic, and that's, you can say the break even is zero, but nonetheless, it's something we're watching carefully. And so, and are concerned about, but ultimately though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there. And, but nonetheless, something we watch carefully.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks. And, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, it has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that I had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January, some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just
if there have been any discussions about the risk of stagflation scenario.
Yeah. So as I mentioned, there is tension between the two goals, right? The upward risk for inflation and the downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal. And we have inflation that's, 1 percentage point above that. So calling that stagflation, it's not, I would reserve the term stagflation for, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s. And I reserve stagflation for that, the word for that period. Maybe that's just me.
Right. So it seems like stagflation fears are off the table, at least according to Jerome Powell and the
With
Federal
Michelle
Reserve,
Lee
which is
with
actually
ABC
good to
News.
hear.
President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I just bought more SoFi.
On that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course, people will feel that. But I don't want to speculate about what that might mean, because honestly, that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do. But in this case, we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves. With what happens in the Middle East, that's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision. And it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is, ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I think the theory is probably right. But as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought, so I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history. And then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SEP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value perhaps in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet. And it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed. And, there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive. And that's just catching up really from inflationary pressures that take a while to get to the price, into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing. And you know, what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that, so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices, because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, they're big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real, and they're material. So we are aware of that, and we're watching it, but you know, we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. You know, we actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of, you know, generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive, because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity, because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time, and so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that, and just briefly on that as well to finish up. You hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really what is the demand growing faster or slower than the supply side? And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
All right. I think the markets are not too happy with what Powell has just said. I see that the S&P is down 1%. Let's take a look. I think in general, there was nothing that was unexpected. He was rather neutral throughout the entire, he was fairly neutral throughout the entire press conference. I think he is also at a point where he is openly telling us that, this is an SCP where it was very hard to make any sorts of projections because of where we are in the world today with the conflicts in the Middle East, with effects of tariffs, and then at the same time, in general, with all the inflation that we have had in the past couple of years, trying to navigate through all of that, it's a little bit hard to see whether or not the oil price shocks will actually reverberate through the economy. But what he did tell us is that the one-time goods inflation due to the tariffs should ease by the middle of the year. So that is one factor that is going to, at least in his opinion, drive down the inflation for the rest of the year. And I think that it's going to keep inflation more or less steady as long as we do not see any renewal of the tariffs, especially after the Supreme Court ruled against Trump tariffs, whether or not he's going to find some other way to input new tariffs. Now, the one thing I want to say regarding tariffs and Trump and things like that is that I think right now, Trump is pretty preoccupied with the conflict in the Middle East. He really doesn't want to lose face over there. So I am thinking, as long as the conflict is ongoing, the last thing on his mind is to go around pissing people off and raising tariffs. So I think it really depends on which side of the fence you fall on, whether or not you are someone that is fully a Trump supporter or not. I mean, for me, as someone that is living outside of the US, it really doesn't concern me which party is in the office, because it really doesn't affect my daily day-to-day life. All it does affect is policies that will affect the market. So take what I say with a huge grain of salt, whichever side you're leaning on. This is not supposed to be political, but for me, I think that as long as he is preoccupied with the war, he's not going to be focusing so much on tariffs. However, I think that because he's going to be so overly preoccupied with the war, I feel like he might be losing control of things that are happening. I know there are people that are saying, "Oh, this is within his plan." I mean, if you think so, and I hope for you in your case that it plays out to be that way, then fine, right? But at the end of the day, it does feel like he's focusing a little bit too much on the war. I don't think that was what Americans wanted when he came into office. So I'm not too sure that's how that is going to affect his approval rating. Now, if he loses the midterm because of the war, then it is unlikely that tariffs are going to come back for the rest of his term, the last 2 years in office. And I think, ironically, that would actually mean that after the midterms, we get a lot more certainty around regulations, and that is when we will see the markets start to recover. But I think from now until November, it's really, bracing for a volatile ride. So during the FOMC, I actually bought SoFi at 17.25, I believe. Let me take a look. I think it's over here. Orders, yeah, I bought SoFi at 17.25, 200 shares. It was just too, to me, the deal was just too good. I know right now that because of this, SoFi is a relatively large position in the portfolio. Let me take a look. If I take 1,200 shares, multiply by $18, that is 21,600. It's 21% of the portfolio. And right now, the diluted cost is around $18.02. I'm like so tempted to just buy another 100 shares to lower the diluted cost down below $18. But anyway. But then after that, we'll have 1,300 shares, and I don't like the number 13. So then, it's just never ending with the OCD. So you know what? I'll keep it as it is for now. I did wanted to buy Zeta and Amazon during the conference. However, when I took a look at the markets, it seems like we could be going down a little bit further. So if I were to zoom in for you, let's take a look at the daily candles over here. Right, by now you are familiar with this line that we have drawn at around 671. This morning, we kind of touched the line again, and then we have come back down, and right now we are down 1.2%. So the S&P is at around 662, and the Qs are down also around 1.2% at 596. So I believe the Qs could come all the way down to the 200-day moving average. Similarly, S&P, I expect this to come all the way down to the 200-day moving average at around 657. Now, I think there is a chance that we overshoot this a little bit, because if you end up drawing this line over here, you see that this forms some kind of, I wouldn't say a strong support, but some kind of support in the past, in the very recent past. You see this bounce off once, twice, I guess you can call this 3 times, right? So I think it could drop in between 650, 657, and that is when I am likely, especially for Amazon, going to open a position in Amazon. So for me, that is the thought process. I'm waiting to see, because right now, I think in the past, whenever I started positions, I didn't really look at technical analysis. I didn't really look at supports, resistance, trend lines, and things like that. And for me, because I used to be someone that believes that, fundamental analysis is the only thing that matters, I am a convert now. Not that I do technical analysis very well, but I do employ some level of technical analysis to find certain buying points. And I am willing to be patient, or even potentially miss a certain move if the technical analysis tells me otherwise. So over here, like I said, I am expecting S&P to retest the 200-day moving average, which would actually be a good point in time to get a correction. You can see since the Liberation Day at 477, this has basically gone in a straight line up. So it's about time that we see a little bit of a correction. I always feel safer once the price actually touches the 200-day moving average and rebounds from there. But if you take a look on the RSI, you can see the RSI is nearly running out of steam. We are definitely oversold on the S&P at around 32, which I think plays in, there might be one last, flush out to 650, 657, around that price range. And from there, we can see a rebound once again. Like I said, not someone that is super into technicals. My technical analysis is like basic level. I can tell support, I can tell you resistance, RSI, MACD, that's about it. And that's really fundamentally all I use, right? So sometimes I turn on my EMA to see shorter terms. So, which is the pink line. The pink line is the 5-day EMA, and the yellow line is the 20-day. So it's basically like a 1-week trend and a 1-month trend. And as you can see right now for the S&P, similar to what the moving averages is telling us, that the short-term trend is a lot more bearish than the long-term trend. All right, so but not to confuse you guys, just keeping these two over here. So let's take a look at the portfolio. SoFi is down 0.5%. It's at 1729. Again, this it's really respecting this line over here. This has been pretty strong resistance in the past. You can see this bounced off 1, 2, 3, 4 times, and then it came back down recently again. It retested. I guess if you zoom in here, you can say that this went up, came back down, and retest, so 5 times. So it tested this $17 line quite a number of times in the past as either support or resistance. This was tested again back in the early parts of March. So it's no surprise that we are seeing this being tested again. If we see this actually break, then like all likelihood we are going all the way down somewhere between 14 to 14.50. I'm not too sure whether the lines are super accurate here. Perhaps around 14 to 14.50. Yeah, you can see once, twice, thrice, 4, 5 times. Also, so I think if we do break, then we're going down to 14.50, which works out fine for me because I have 20 cash secured puts at $15. So that is the SoFi position in terms of Amazon, right? We have more or less closed the first gap. Whether or not we'll close the second gap remains to be seen, but the death cross is formed. We have seen the first rejection of the resistance over here. Last couple of days, this has been, bobbing around in the high 210s, right? And I think right now what we are seeing is that the Amazon basically is selling off with the rest of the markets. I am hoping to get this, I would say, in the $200 ranges. So I'm not really going to be picky anymore and just keep selling cash secured puts. I think for Amazon, I've already sold 3 cash secured puts. Even if I bought at 210, I remember my cost basis would be around $202. So really, it's not an issue for me. Right now, like I said, once the market touches the 200-day moving average, that's when I'll make my first Amazon buy. For Grab, nothing much to say over here. This is a long story. You can see this has been in an extremely long downtrend all the way from September to last year to March of this year. So for the last 6 months, Grab has done nothing but gone down. And I think this is one of those cases where you can't just look at this. This is one of those cases where the technicals, you have to look at a number of indicators in tandem, because you can't just say, oh, the RSI is oversold, so I'm just going to buy and then it's going to come up, because the market can obviously stay a lot more irrational longer than you can stay solvent, right? So in this case, it's basically a 6 months of a decline. I don't think there's going to be any near-term catalyst to bring this back up. This really has to be a long-term compounder if you're buying into this position. Now, for Robinhood, again, range bound, not much happening over here. Tempted to just go out and buy Robinhood at $75. I think I'll be doing everybody a favor, because the moment I do that, Robinhood's going to come down and touch the support at $67. That's just what happens when I buy companies. Zeta, okay, we are really right at that line. You can see we have just broken down again, 100-day moving average. We are really right at that line. Depending on where it closed today, this used to be support. We might have to turn it to resistance, right? Especially depending on where it closes today and what happens tomorrow as well. But you can see further than that, there are 2 lines here at around 1630 and around 1470, around there. I think those are the price points where it makes sense to buy Zeta. So anywhere between in this box, right? Between $14.50 and $16, that $2 price range. As long as I can get Zeta between there, I'm not too fussy about the price in that range. I'm perfectly happy. My cash account puts are for $16. Then for Iran, I think interestingly, this has stayed fairly. The move in Iran has been fairly muted despite all the volatility that we're seeing in the markets. It's only down 1.5%. Okay, so if you take a look, this has rejected off the 50-day moving average. Yeah, and I'm not sure. It's really in no man's land right now, and I've learned over time that stocks don't generally stay in no man's land for very long, right? So either I think we are likely going to see it come down to the support line over here, which just nice basically is a confluence with the 200-day moving average. So over time, as the 200-day moving average comes up, eventually this will come down somewhere around $38 or so. And that is exactly where we have sold our cash account puts. Now with Iran, because of the concerns I was saying regarding their contractual issues, right? They may have a lot of power in their data centers. If they do not have contracts to those powers, then unfortunately, it's still not going to matter. right? So for me, that is the entire position in the portfolio. The first thing I'm going to buy likely is Amazon and data. Thereafter, I'm going to be adding Robinhood. Iran is something that I am looking at very closely, as well as let me see, as well as I wanted a cybersecurity play. So over the next couple of days, I'll be doing a comparison between Iran and Nebius, and then I'll compare Rubrik and Sentinel-1. Yep, I think that's about it. Let's see. Let's look at what the rest of the markets are doing. Like, there are so many good companies out there that I want to buy, but I do not have the cash on hand right now. CrowdStrike, Rubik. Circle is like a monster. Nothing can really take this company down. I really regret not buying it in the 60s. Really. I was just doing my research on it, spent about a week or so, and then I thought, you know what? Let's see. I told myself, let's see what happens after earnings. Worst advice to myself ever. Look at that. Oh, I've doubled my money. ASTS, let's see, where is that? Okay. I mean, I think I understand the premise of ASTS, right? And I know the community around ASTS has done so much research, but I really haven't gotten a chance to get into it. C Limited, my goodness, this is still at 84.70. I've always wanted a chance to get in at 90. I'm just weighing the pros and cons of holding this in my portfolio compared to Grab, and whether or not holding both would be too much. So even if I hold 100 shares, let's see. Let's go out 30 days, April 17th. If I sell a put at, where do I want to buy this? Let's say $75. It's 153. Let's call it 160. That would be okay. If I can sell a cash account put at $1.55 at 75 cents, that would be a 2% return across 1 month to own C Limited. I remember you told me about B-Fly. I haven't gotten to a time to look at it because I was doing the research around Zeta and Reddit previously. Right now I'm digging into Iran and Nebius, but that got interrupted by the short report on SoFi. So my hands are a little bit full at the moment. I will probably dive into the cybersecurity names sometime next week before I head over to Vietnam. And then once I'm back from Vietnam, like I say, you're going to have me every day over here so we can do deep dives a little bit more often. But right now, I'm just considering whether or not I want to sell a cash account put on C Limited. $75, $1. Okay, see, it's nearly $1.60 now. If I do this, I believe I'm going to be selling the cash account puts on margin. I believe so. See, this is a public portfolio. And sometimes I know there are some people, I know my friends, some of my friends who are following me, some of them are extremely new investors. I do not want to teach them bad habits right from the start. That's one of the things I'm worried about. Like, I can manage the position perfectly fine. And if really I do need to buy, I can either choose to cut my losses, and I'm extremely unemotional when it comes to cutting losses, or yeah, like I said, the rule is that I can't what do I want to say? I can't put in any money into this account until the first trading day of the following year. So we have to work with that 100K. So it's not like I can just put in money and just buy the position. I would have to cut losses somewhere. Perfectly fine to do that. It's just that for C Limited, I don't know. Let me do the math a bit. 1,500 shares of Grab at 424. I have $6,000 in that. And then if I add in 7,500 for C, that's only 13% of my portfolio in Singapore. Not too bad. Not too bad. Something I'll consider. I won't do it now. Let's see what happens tomorrow. Really, I think let's see what happens tomorrow. I think there are more companies that I would rather buy right now. It's not that C Limited is not good. It's just that with the kind of rate that we are seeing in the markets right now, like I would rather add rubric into I would rather add rubric into the portfolio right now than C Limited. Nice. Well, Lawrence, Palantir since 10, him since 4, and SoFi since 7. B-Fly since 170. All right, then I really have to take a look at this along with the rest of the cybersecurity names. At 170, so you got in late last year, I presume. All right, it is in my watch list along with the rest of the cybersecurity names. So when I take a look at Sentinel One, I will remember to take a look at B-Fly as well. Also, do you hold Sentinel One as well, Lawrence? UiPath. I looked at it for a while. I didn't really understand their value proposition. But when I said I looked at them once, I meant like, I think back in 24 or so when they first IPO. Haven't looked at them since. UiPath. UiPath is $12 today, $12.50. Wow, wow. I didn't realize they were $90 when they came into market. Why do you like UiPath, Lawrence? I haven't really gotten my head around it. If you could take a look at my watch list, these are all companies that I am looking at, both for my main portfolio as well as this public portfolio. For me, Nebius and Circle are definitely names that I want in the main portfolio. I don't think I have enough capital to make these a significant position in the smaller portfolio over here, because you can see Nebius is already 100, close to around, let's call it 120. Circle is 130. So just buying these two names, that will make up 25% of the portfolio in Circle and Nebius. And I think there are still risks, especially with Nebius, there are still risks despite of how many deals that they have signed recently. But I think it's a lot safer than Iran. The reason why I'm doing Iran is because it's easier to roll in this portfolio. Then you can see Rubric, Butterfly Network, which Lawrence just recommended to us, as well as CrowdStrike over here. These are the cybersecurity names that we'll be looking at, as well as ASTS. Then we also have Air Test Systems, C Limited, MCore. I mean, Bitmine is just here for me to keep an eye on it. Okay, so Bitmine rejected the 50-day moving average. I think nothing too surprising over here. Right now, this area over here is kind of acting as a very short-term support. Let's see whether it holds, right? If it holds, then we are all good. You can see this has bounced over here a couple of times. Sometimes what I like to do is to actually move into the 4-hourly chart so you can actually see it more clearly. So if you take a look, it's been 1, 2, 3, 4 times. Actually 5 rejections over here before finally breaking out over there. And right now we are retesting this same area. So on the 4-hourly chart, it does seem like Bitmine is just basically retesting a support. It used to be very strong resistance, which means it should be pretty strong support as well, right? So that means I'm expecting, over time that this will recover, because if you take a look at the price of Ethereum, Ethereum similarly on the 4-hour chart, you can see as the similar trend going up, coming down, testing the moving averages over here. Of course, this is in the 4-hour. If you take a look, okay, it's supposed to come down maybe to 2100. It has a little bit more further down to go. As long as it tests this and bounce back up, I think we can retest at the 200-day moving average pretty soon. Okay, gold price is dropping. Yesterday, 2 days ago, when I was at a cafe, for those of you who are from Singapore, Tiong Bahru Cafe, I was overhearing a conversation between the guy and his financial advisor. He claims, or he was trying to tell his financial advisor, he wants to buy more gold. I mean, I didn't listen to the entire conversation. I hope the financial advisor did not let him buy more gold, because if you look at it on a weekly basis, this is exactly what you're getting. And his argument is that, gold has beaten the S&P 500 in the last 5 years. Yes, that is true, but because we have had 2 wars in the last 5 years, and worries about extremely high inflations, and then we have tariffs, and I think there's so many things contributing to this. But beyond that, if you take a look, gold has basically been flat since the pandemic all the way until 2024, before all the nonsense came in. So the returns of gold has been boosted by volatility in the last 2 years rather than any fundamental change. And then if you go further out, you can see there tends to be a sharp rise, comes back down to the moving averages, which is in this case in the $200 ranges, because eventually you can see from 2018 there's a sharp rise. Over time, this slowly trends back down to the moving average, and then it bases again for quite a long period of time, which is why over 90% of the time in the last couple of years, gold has not done as well as inflation, because the price really doesn't tend to move. So I think a lot of people are very enticed by gold due to the recent near-term price movements, but I don't think that this is the safest play that you have at the moment. Like when you see these kind of parabolic moves, to me, this is never the time to buy. Let's take a look. Okay, Lawrence is saying BeFly is handheld ultrasound, medical device. Okay, yes, I own. Talking about medical device, actually, one of the companies that I've been looking into before I decided to drop the healthcare sector is actually TMDX. I've always thought it was an interesting company, but I guess it's a company that I will be following, but I might not take an active position in them. Path is a value AI play, cash rich, no debt, cash flow positive. Right. The thing is, I've been listening to a couple of people talk about Path, and I think a lot of the engineers don't really see the value proposition. So I think if you are going into Path as a more of a compounding kind of stock than hoping to get Palantir-like returns, then you are in the right. I was going to say in the right path, pun not intended, but you're on the right path. But if you're hoping for a Palantir type return, it's a bit hard for me to judge the efficacy of their products right now. I haven't used it myself. It's just talking to people, listening to different interviews. It seems like there's nothing much at the moment differentiated from past products. So it's not that it's a bad company, but it is not going to be something that experienced like super parabolic kind of growth. But yes, I agree on a fundamental basis, they could be in a fantastic position. Inflection for these companies really take off and reaching cash flow positivity, especially with no debt. Yep. And I think that is exactly what we are seeing with Zeta, which is why I'm quite inclined to start a position, even here in the $17 ranges, but I'm holding myself back a little bit, waiting for the markets to fall. And I think we are seeing the markets fall as we go into the close. S&P is at $661. Okay. Oh, they have a partnership with Midjourney. All right. So this is really something interesting that I have to look into. Okay. All right. So going back, you can see S&P 500. It's now down 1.3%. The Qs are down also 0.3%, and the Dow Jones is down 1.7%. So if you take a look at where we are in the markets, I think the S&P 500 getting closer and closer to the 200-day moving average. Sorry, we're over here. Similarly, Nasdaq is the same. Wouldn't be surprised if tomorrow we actually open red, we test the moving average, and then we get a bounce. I think Powell hasn't done anything in this last meeting to calm the fears. I think he basically tried to stay as neutral as possible, because I think that is what he should be doing. I mean, he didn't do anything that he shouldn't do, but I think as a result of not getting that kind of clarity, the markets are a little bit fussy at the moment. Netflix to 100 by the end of the year. Netflix, where is Netflix right now? 100 by the end of the year. Okay, possible. I mean, if the market recovers, I think if the market recovers, Netflix should get 200. I didn't know they fell so much from 134 all the way to 76. Wow, that's nearly a 50% drop. I don't follow Netflix very closely right now. I used to before the stock split. I stopped following them as closely. The only thing I follow on Netflix is that I know One Piece is out. Just started watching the first episode today of season 2. So that's the only fundamental analysis I have for you on Netflix. Season 2 is out. Episode 1, pretty good. Let's see. What other names do I have? Zoom. Zoom is okay, still basing in the 70s after the drop. Enphase is around $43. So Enphase has done pretty well. I think it closed the gap, which was important from a technical perspective. Rebounded off the 50-day moving average, and this is slowly seeming to be trending upwards, right? So to me, everything should be fine with Enphase. I'm really tempted to add a little bit more SoFi to this portfolio over here. Let's take a look. The reason why I'm not going off is because I am like in my head debating whether or not I should be adding some Amazon right now. That's why I haven't gone off. I really don't like buying in no man's land. It is a tough lesson that I have had to learn previously. I do not like buying in no man's land because I know the moment I buy, everybody will get to buy Amazon at 195. I'm like 90% sure of it. Does anybody want to buy Amazon right now? Anybody has the same kind of luck? You can buy Amazon, so I can buy it at 195. What price would you try getting into Zeta? So earlier on, I said we are really right at the line at the moment. Okay, so yesterday, the last couple of days, we've been testing the 200-day moving average unsuccessfully. So today, we basically really saw a full candle coming down below the 200-day moving average. Now, if you take a look at the recent support and resistance, you can see when it came down, it actually bounced off this support at 1620, bounced all the way up to the resistance at around 1750, came back down again, right? And then similarly, when it went up, just past this resistance line at around $17, came back down, retested, and went up again. If I go all the way back, you can see in December, this line was tested once. Again, over here in October, tested another time, and a couple more times in August of last year. This 1720 kind of line has been a support in the more short to medium term. I don't know whether you will consider August medium term. I think short to medium term. And it seems like today we are likely going to be closing under this resistance, which means we are likely making our way down to retest 1620. So earlier on, like I said, you can see 1620. There's 1, 2, 3, and then over here 4, 5. Similarly, in this range around 1470. There are a couple of tests over here. So anywhere between this $2 range, 1470 to 1620, that's when I'm looking to start the position. In the past, I would say that there's always a part of me before I learned all this technical analysis. And again, disclosure, please do not listen to me when I talk about technical analysis. Okay, I may be just talking out of my ass. I'm still learning when it comes to technical analysis. If you listen to me on fundamental analysis, sure, I'll say fine, right? I think I do dive pretty deep into companies, but when it comes to technical analysis, take my words with a huge grain of salt. This is like, therapy for me, like talking to you guys about my technical analysis, because I got nobody else to talk to about it. Like none of my friends really do this. So Zeta, like I said, in my head, it feels like between 14 to 16.20 is a good price to get to. So observe whether or not this closes below our resistance. If it does, and we get another candle lower, likely we're going to. So I think what I will plan to do is to buy a small position in the $16 ranges. I wouldn't exactly wait for 16.20. Honestly, if Zeta really does what we think it would do, it really doesn't matter whether or not you're buying at 17 or 16. Honestly, that is my honest opinion if you ask me. For me right now, I am extremely capital constrained in this portfolio because I'm not allowed to add new capital. I only can work with what I have. That is why I'm trying to be a bit more anal with where I pick my positions. So that was a very long yet for a short question, but yes. Okay, to answer this question, between 14.70 and 16.20, that $1.50 range, that is ideally when I would like to buy. Whether or not it will get down to that range, I do not know. But we have seen a couple of times that Zeta does bounce off the 16.20 range, and I will not be waiting down for it to come down to the exact cent. As long as I can get Zeta in the $16 ranges, I will open my first position over there. I think for Amazon, if I can get it somewhere in the 205 kind of range, I will start to open a position over there. All right. So yeah, really, this is therapy to me. No, I'm serious because I would say that the investment community in Singapore is still fairly new. It's still developing, and I think in America, if you are in your okay, at least my impression from Singapore is that if you're in America and you're in your 20s and 30s, generally you follow the markets to some extent. That is, at least for people in the 30s, I can tell you that that is not the case. Like majority of the people I know who are in their 30s, I am 36 this year, by the way. They do not really follow the markets. They don't really know what's happening. And I think everything that is coming out of my mouth in the last 20 minutes is, at least to most of them, I'm pretty sure sounds a little bit foreign. Or all right. I think one of the things I want to do as we wait for the market close is to update my spreadsheet over here so that we can have a better understanding of the portfolio, since there's only 12 of us chilling here. Of course, if you got questions, you guys can ask me anytime. I'm happy to take on any questions during this period. But otherwise, I want to work on my spreadsheet for a minute. Because I kind of screwed up the spreadsheet when initially I was using this to track my parents' portfolio, but right now it doesn't really work for our purposes over here. There are two companies for me that are going to be the cornerstone for this portfolio, and that is Amazon and SoFi. Right, so that is going to be the top two positions over here. So let me see. All right, so let me. What's this? All right, so we are just going to take a look at this. I think there's no need for me to track the shares transactions over here. Anyway, there's not enough room for me to do it, if you ask me. Every time I make a buy or sell, I will just increase the position over here. I think that's the simplest way to do it. So right now, like I have no Amazon position, right? I'm hoping to buy at 205. I'll leave it at that. And in terms of SoFi, we have just added. So 1,200 SoFi shares. I believe it is at, let me take a look. Oh, the $13 gap hasn't been closed. Wait, let me take a look. I was just looking all the way until August. Give me a second. How much is my? Okay. $18.03. So invested capital 21. Oh, I forgot to close this. Okay, so this is closed. So right now with SoFi, we realized I have $510 in premium last quarter. Oh my goodness, see what am I talking about? Last week. It's 4 a.m. in Singapore, guys. I know for you it's not so late. It's 4 a.m. in Singapore. My mind is half working. Amazon versus Microsoft. Microsoft seems like a very good deal too. Let me be very, very honest over here. I know Microsoft is a good deal, but I do not use Microsoft much other than, I do use, see, irony. I'm using Microsoft now. What I meant is that I do not use a Windows laptop. Haven't used a Windows laptop in a long while. And that is why, I haven't really bought the stock, although I know it is undervalued. But because I only have 100K in this portfolio, and I know that I'm going to make SoFi into a relatively large position, maybe around 25% of the portfolio, hoping Amazon to be making up the other maybe 20% of the portfolio. With that, 40% of the portfolio are going to be in companies that I know I do not need to look at for the next 1 to 2 years. And then with the other 60% of the money, we can go and look at companies like Iran, which I would never buy I wouldn't buy Iran in my core portfolio, but I wouldn't mind trying it over here. Okay, you know what? SoFi just dropped below 1720. Should I buy? I think I should. Give me a minute. Let me do the calculation. Would I be using too much capital on SoFi? That's the question. But if you're asking me on a fundamental basis, Microsoft, fantastic. I think Microsoft and Amazon, you really cannot find any better deals in the market right now than these two companies. Path just partnered with Microsoft. Oh, really? Are most of you guys from the US, or which part of the world are you from? Anybody from the UK? No, the reason why I asked is because I just got notification that Liverpool started playing Galatasaray, and I'm just wondering how many of you actually watch football. Oh, not football. Sorry. If you're from New York, it's called soccer. Nice. I would love to visit New York sometime. Okay, give me a minute. Let me see whether or not I am being too heavily into SoFi, but really. All right, so at the close of market, SoFi is around $17.18. I might just put a small buy in after hours. Okay, that would mean really 25% of my portfolio is in SoFi. A little bit of a cheap move. You know what? I'm just going to buy more SoFi in my main portfolio, I guess. If I really want to. Okay. I'm going to be good. I'm going to keep it. I wanted to buy another 300 shares of SoFi, but you know what? I will just buy another 100. Okay. I think it's fair. Another 100. I can't help it. I need to bring this below. Do I sell calls against my positions over here in this account? Yes, but right now not at this point in time for SoFi because it has been falling because of the short report and because of the market momentum. But I do sell calls against my positions. Oh, I got 100 shares of SoFi. So I bought 300 shares of SoFi today. My cost basis is now, I believe, in the $17 ranges. All right, I held myself back. I wasn't the degen and going all in on SoFi. I really like SoFi, so Oh, sorry, accounts. Still not used. Okay, so my my diluted cost basis for SoFi now is $17.96. You guys can see over here. Thailand, Seattle, Washington, go United. My goodness. I can't believe Michael Carrick is doing such a good job. You know, it was always okay in the last couple of years. Whenever Liverpool didn't do so badly, you just have to look down the table. United is below us. That's fine. But this season is particularly irritating because you were below us in the table and then you overtook us. All right. So anyway, update. 1300. This is my SoFi position. Will not be adding anymore. Maxed out the position. 1796. So we'll be updating this in the spreadsheet. So we have 1300 shares of SoFi at. You know, in the funny thing is that in Singapore, at least in Asia, we don't really say 1300. We say 1300. And I've been saying 1300 basically my whole life. Until 2020, when the pandemic locked us in, I started watching YouTube. And then all these financial YouTubers from America started talking about numbers in 1700, 1800. Sometimes subconsciously, I use those numbers as well. And it was a problem when I was teaching, right? Because when I was teaching, sometimes I slip of mouth, I call it 1300 and they don't understand it. All right, so right now, SoFi makes up around 22% of the overall portfolio. I have a hard time buying SoFi here since I bought at 7. I do sell puts on it and roll them down sometimes. Right? I mean, yeah, everybody has their own strategy. I think what has worked for me has always been buying into strength, buying into the same companies. So I would much rather own more shares of companies that I know with slightly higher cost basis. Because if you think about it, like someone buying Apple back in 2009, I don't think back in 2009, buying Apple at 50 and 80 might seem like a world of difference, but compared to where they are today, I don't think the person buying Apple at 80 regrets buying at 80. So similarly for me, although I started accumulating around $8, I'm perfectly fine. I basically doubled my cost basis in the last 6 months because I bought another 5,000 shares of SoFi between $18 and $24. No, you see, that's the thing. Right now, I realize why you guys call it 1300 because 1300 is so long. But then in Singapore, when you say 1300, people think I'm just being pretentious. So I force myself to use 1300 when I'm talking to other Singaporeans. But I do agree it's faster. Yep, precisely. Anyway, so with that, 1300 SoFi shares, 1796. Last week, we realized $510 in premium, adjusted cost basis of 1757, which means this is an adjusted P&L of negative $504. No problems over here. Amazon still haven't opened a position. Like I said, once the S&P kisses the 200-day moving averages, then that's when I'll initiate a position in Amazon. Our hood position, no change over here. And I think what I really need to make the biggest changes to is over here. Right now, this is in a mess. I don't think I'm going to be owning C Limited and Reddit. So these two companies I need to get rid of. Give me a minute. So Amazon gets it from C2, SoFi C2, grab here. This might be controversial. I'm not sure whether or not I will be owning Nvidia in this portfolio because I'm already making SoFi such a big position. I think my fourth position that I would like to keep closer track of is actually Robinhood. And then the fifth one would be Zeta. That is likely going to be my top 5 positions: Amazon, SoFi, Grab, Robinhood, and Zeta. Which means I don't need this here. And we are likely going to... I'm just using rubric here as a placeholder, but it's basically going to be one of the cybersecurity names. I'm just using this, like I said, rubric as a placeholder for now. And one of the things that I am thinking about actually is to use to replace my Nvidia position with a little bit of Nebius, because I'm not too sure how much I really like Iran. Like I said, my concerns are mostly around their contracts. So that's that. So I think right now, Amazon Hood, I wouldn't put Grab as number 3. If I were to arrange this according to conviction, I would say that Hood would be number 3 in conviction, followed by Zeta. And then maybe after that, Grab. Yeah. In that order. And then from there, okay, from here, we have rubric. This is a position. And, okay. I think the ironic thing is I have Iran cash account puts at $38. So I might have to change this Nebius. I might have to change this Nebius tab to Iran in future. And then if I have capital remaining, I will do Nvidia. I think Nvidia is nice because you can basically have their they basically have very juicy premiums. All right, so all the ticker symbols are correct. I don't think I will get up to 10 positions. I think it's too much for a $100,000 portfolio. Number of shares, 0. Fantastic. Number of shares, I should just use it here and I'll... Yeah, I think I'm going to make it simple, and I'm not going to... Yeah, I'm going to make it simple. I'm not going to have all this share transaction aside. I'm just going to delete this whole portion, at least for this portfolio, because there's no point of me keeping track of these transactions over here, right? The brokerage basically does that for me. So I'm basically double counting. I'll just keep the position information over here, and then we'll just read from this cell whenever we are doing our calculations. Grab, we have 1,500 shares. Rubric, we have no shares. Nebius Group, we also have no shares. Okay, we do not have 100 shares here. Sorry, YouTube channel you. Who is you? Like me? I don't know about a YouTube channel called you. I remember Chris's friend, Sam, right? Sam spoke about Iran a while back. So maybe I have to listen to what he has to say. Let me just put this. And Nvidia. All right. I think for now, I can keep the last... I don't like to see all these hashtag few and stuff. Let me just delete this for now. Numbers are correct. Eventually, these are the positions likely to be in the portfolio. I might replace Nvidia with something else if I really do not have the capital to do so. Cost basis, let me make sure everything is correct. Amazon cost basis over here. SoFi's cost basis over here. I'm going to be counting this based on the actual cost basis, not the adjusted cost basis. And for like Robinhood and Zeta, the reasons why the cost basis are the way they are, this is basically the cash account puts that I have sold. Right, Zeta is 16, right? Why do I have it at 17 here? Zeta is... Do I have Zeta at 16 or 17? 16. Okay, so this is wrong. This is 16. For that, nothing changed. Okay. For rubric, I don't think the average here. Let's just call it $50. I'm buying it around 50. For Nebius, which could easily be Iran, that's over here. And for Nvidia, Nvidia's over here. So Nvidia, the cash puts are at 170. That's it. Nebius, haven't sold it yet. Let's say 100. Rubik. Okay. So these numbers are fine. So from here, this is the initial capital. This is the current price. Current price. Are they updated accordingly? Yes, because it is based on the cells over here. Fantastic, fantastic, fantastic. All right, this is the current value, which is basically current price multiplied by shares, and then the P&L. So basically, this P&L that we are looking at over here is basically the P&L without adjusting for the options, just purely the capital appreciation. All right. YouTube channel, he likes Aaron's. Okay, I'll go and look for that YouTube channel then. I haven't heard of him before. I will take a look if you say that he has Iran content, because I do have some questions around Iran, and I think because I'm so preoccupied with the SoFi short report that I haven't had time to look into it. So anyway, my point is I'm just building this up because I'm wondering whether or not I should include P&L, adjusted P&L. But yeah, the problem, maybe I should do that. I don't know. I'll see how to put this. And then most importantly is the allocations over here so that I can make this all into a nice bar pie chart, right? Pie chart. Amazon, you basically take current value divided by total value. Oh, how did I get my total? All right, the current total value. Okay, yes, correct. This is correct. 22%. I should put this at least one decimal place. Yep. All right, I think we are good. Okay, I will do this. At least now I know the cells are fine. I'll do this up later. Okay, it's been nearly 2 hours. I will take a look at YouTube channel U. It's just called YOU. And then I'll come back on Friday to talk a little bit about Iran. Later today, I'll be posting a BMNR video, basically because I tried to record it during the stream on Monday, but because I was answering questions, it was a little bit disrupted. So I tried to put everything together in an undisrupted manner. That will be coming out on Thursday. Later tonight. Yeah, I mean, it's tomorrow for you guys, but it's tonight for me. The SoFi short report, I am working through it. I will try to put it out on Friday, but no promises. But by the weekend, definitely. Because I've been looking at a lot of the responses to the short report, and I think a lot of the responses are good in the sense that they challenge the perspective of the short report by saying that, you know, the management team is being heavily regulated and things like that. And the management team has actually more to lose. That is all well and good. But I want to get a step further and to actually challenge some of the assumptions, the mathematical assumptions that they actually use in the short report, to show without any kind of assumption of saying that, you know, they must be trustworthy because they are audited. I think that is definitely true. But I think I want to go one step further and hopefully be able to show in a very understandable, easy manner that even the math they are using are full of their own assumptions, and they're basically presenting to us their version of the story. So that's what I hope to do, which is why it's taking a lot more. I'm not just coming out to say that, guys, believe Anthony, Nodo, and T because they're regulated. That's not what the video is about. I'm basically digging into the numbers, trying to see the assumptions that they are making behind some of their numbers. Like, for example, the headline number, 6.1% charge-off rates. You would realize that half of the metrics that go into that 6.1% are based on literally their own assumptions. So while most of the other creators have a valid point of wouldn't you rather trust Anthony Noto because he is more heavily regulated? Conversely, you can apply that to this situation and say that why in the world would anyone trust Muddy Waters when they are not regulated and this is literally their own assumptions? Then I can also assume that next quarter, SoFi's take rate for their loan platform business grows to 10%, and I say that they're extremely undervalued. While we're at it, we can also assume that the tech platform makes $2 per account revenue, $2 of revenue per account as well, right? And then SoFi is going to be minimally growing at around 45% this year. Like I said, if we are in the playing with assumptions, you can put anything you want, which is the ridiculous thing about this report when I looked at it. And that is what I'm hoping to break down. It's going to take a little bit longer. Friday, if not weekend. And with that, thank you. I am so amazed that there were 9-10 of you all the time even to now. This is the first time I'm streaming the FOMC, definitely not the last. I will see you back again for the FOMC meeting in May, which should be Jerome Powell's last FOMC if we have a new Fed chair by then. Thank you. Good night. It is 4:20 a.m. my time. It's way past my bedtime. I really should be going before I continue talking to no end. Good night. See you. Bye.